thank you all for joining us here today. We're going to be talking about the world economy, and in a tour de force, we're going to cover the entire world in less than an hour. Let me introduce, please, Isabel Vansteenkiste, who's going to cover Europe. She's the Director General of the ECB. Leland Miller from China Beige Books is going to cover China. Zentner, the Chief U.S. Economist at Morgan Stanley, is going to cover the U.S. And then Rémy Rioux from the AFD is going to cover everything else. And then we'll open up to questions. Because we have a brief time, we're only going to talk for about 10 minutes and without slides. So with no further ado, Isabel.
Thank you very much. I hope this microphone is working well and you can hear me. Let me first start by thanking the conference organizers for inviting me to this conference, to have a conference in person. It's a very nice feeling. And to be in the Louvre. I mean, I was here as a teenager, and so it's nice to be inside this building again. It's a fantastic museum. I'm coming after a very hard act to follow, actually. So the governor has already said quite a bit on Europe, but I will try maybe to go a little bit more in detail on some of the developments that we've seen in Europe, and particularly also linking to the geopolitical context. But before starting on what we have seen since the war started, I wanted to give you a little bit of a primer on what we've seen in the pre-war situation in the euro area. And I think that's important to set the stage of kind of the context in which this shock hit the euro area. And actually what we were seeing, and that was a global phenomenon, was that the euro area was bouncing back quite well from the pandemic. We saw growth actually at the end of last year more or less at the pre-crisis levels, although in trend terms, the euro area was still lagging behind the pre-pandemic trends, and that was mainly because service sector was still catching up from the pandemic. So as the governor mentioned, labor markets did pretty well, and actually it was really the brightest spot, I would say, in the recovery. I mean, unemployment rates were lower than any time we've seen since the start of the euro area. And inflation was already actually on the rise, and there were several factors there. I mean, one was energy prices. We had already seen an increase, and partly was, for instance, in the natural gas market. We saw quite a steep increase in global demand, for instance, from China, and that was pushing up already gas prices. But also this fear of the war was already starting to have its effect. But there were other factors as well, such as the supply bottlenecks, and here we can have a long discussion on what was the supply factor versus demand, but let's say it was an imbalance between supply and demand that we saw, especially in the manufacturing sector. Because on the one hand, of course, you had this strong recovery in demand, but at the same time, you still had the pandemic, implying that in some regions of the world, there were still shutdowns that disrupted supply chains. And then, of course, the reopening of the economy generally led to some, like, say, normalization of inflation. We had very, very low inflation. We shouldn't forget that during the pandemic, and that was normalizing somewhat. So then the war, of course, hit, and I think the war was really hitting the euro area through three main channels, and it's been hitting, and it will continue to do so. And the first one, of course, and the main was its commodity prices, so I'll spend a bit of time also weaving in on commodity prices. And then we, of course, have the more difficult to measure channel of the confidence effects, and then the trade disruptions that we may see because of that. So when we look at commodity markets, and maybe just take a general picture here, I mean, what we really have seen is either an effective disruption in supply or a fear of further cuts in supply, either from the Russian side or because of sanction measures, that of course lead to a rise in the prices of a number of key commodities. And I mean, you just need to open your newspaper to know where we have seen high prices. I mean, oil is very much mentioned, gas, but also food, fertilizers prices. Now, if we compare this, and that's what now often is being done, to the 1970s, you know, the shock, of course, is again a commodity. It's an external shock. But what we see back then was it was mostly oil, and now the shock is actually much more broad-based. And so if you look at it also like at an HSCP inflation perspective, actually the increases that we saw, for instance, in energy, because it wasn't just oil but gas, it's across components, is actually something that was really unprecedented. Yeah. The other factor that we of course see is that this is going to be a very drawn-out shock. So on the one hand, on the food prices, you know, the worst is yet to come, because the impact on fertilizers, on meat prices is still further down the road. And of course, the war also leads to some geopolitical decisions, such as turning away from external partners for strategic resources. So for instance, in Europe, that means we go more to renewable energy. And that, of course, means that on hydrocarbons, we may expect this to be a rather protracted shock. So for the euro area, this commodity price shock, it means an external shock, which is a tax basically for the economy as we are a net commodity importer. So it makes production more expensive and it erodes, as the governor already mentions, household purchasing power. And it's actually already clear when we look at surveys of households, that's what they're saying. They expect their financial situation to worsen in the period ahead. And it's, of course, the kind of shock, as the governor mentioned, that central banks don't like to deal with. It's an adverse supply side shock, so it creates difficult policy trade-offs. Now, the second channel, as I was already referring to, is this confidence channel. And that's, of course, one that's very difficult to grasp. Now, if you look at historical episodes, if you look, for instance, at past major geopolitical events, such as the Gulf Wars, we clearly see that this has tended to lead to higher precautionary savings from households and lower business investment. So that's, of course, something that we need to keep an eye on as well. And what we already see, of course, in the surveys is that business sentiment has worsened. And, it's in particular in the period ahead. So if you ask businesses, how do you see the current situation, they see maybe some slight worsening, especially in the manufacturing sector. But if you ask them what you see 6 months, 12 months ahead, this is where they see the biggest worsening. And of course, that will be on business investment. And then the third channel, which we of course can look at, is the trade disruptions. As mentioned, supply bottlenecks were already there. And of course, the war has made this worse because Ukraine is a supplier, in some cases, of very key components. And these may be little parts, but they're key for the production process. Now, you may have read this, for instance, on the car industry, that this has caused some quite important disruptions. But if you look at them, is this macro critical? And so far, actually, when we look at the data, this is not, it appears not to be a material factor. Yeah, because if you look, for instance, at North Sea port imports, we don't see such material impact. But that doesn't mean there's no trade disruptions going on for the moment. It seems more that it's located in Asia and in China in particular. But I leave that aside because other speakers will say something more on that. So, but at least for the moment, we see from the Ukraine, the trade disruptions, they're there. But they're far less material than, for instance, the impact we see from the commodity prices and from the confidence shock. So what does this all mean for the near-term outlook? As mentioned, of course, this weighs negatively on growth. Inflation keeps surprising on the upside. But of course, remember the context in which I placed this. So, we were in a situation where the economy was bouncing back. And so now we're having two countervailing forces. On the one hand, the services sector continues to recover and do well, whereas the manufacturing sector is taking the hit. And interestingly, maybe as a side remark, it's really those parts of the economy that did quite well in the pandemic, let's say relatively, that are now taking the bigger hit, right? And so overall, of course, that means that we're expecting weak but still positive growth. We saw, for instance, in the first quarter of this year, 0.2%. And that's kind of course, bearing other shocks, the kind of baseline that one can think of going forward. But of course, growth is especially expected to be weak because households' purchasing power overall is expected to be dented, and that is likely to weigh on consumption. A factor that here helps is that households have accumulated, of course, a large cushion of savings during the pandemic, and that's often mentioned as a factor that could cushion this blow. But if you look at who has accumulated these savings, it's mainly wealthier households, whereas, in fact, the ones that are bigger hit by this rise in energy prices are the poorer households. So this may run its course at some point. And then on the inflation side, just to mention, as the governor has been already quite explicit on that, I just wanted to mention one figure, and alluding already to how important this energy price shock is. If you look at energy price inflation in the HICP and the euro area in the latest data, it was 38%. I think in April, in the previous month, it was 44%. If you plot data for the last 60 years, so even if you cover the 70s shock, I mean, this increase is off the charts. It's really, really exceptional. So this is something to keep in mind. And of course, everybody was caught off guard by that, but I guess everybody was caught off guard that the war actually happened. It was a risk, but it was not necessarily that we had this as a baseline scenario. Now, to conclude, maybe looking ahead, what does all this mean for the more medium-term outlook? And of course, there's two fundamental questions which central bankers tend to struggle to answer. We are not geopoliticists and we are not health experts, but of course the pandemic and the war will be continuing to be important factors driving the outlook. But I think in terms of indicators to look at to understand what the medium-term implications will be from this shock, I think one important question is what are the confidence effects? We start seeing some effects, but what will be the full-blown effect of that? It's something very difficult to grasp as economists. And the second question is what's going to happen to wages? And this is in particular when we talk about the inflationary question. Now, I've been doing some own research on that in the past, and what you tend to find is that the the link between wages and inflation, I mean, it has weakened over time, but it tends to be stronger when there's demand shocks than supply shocks. So you would think this pass-through should be weaker in the current environment because businesses are less likely to pass on this higher inflation to higher wages and back and forth. But of course, what we also find is that this crucially depends on what happens to inflation expectations. So in the 70s, this wage inflation spiral was very strong, but inflation expectations were de-anchoring. Whereas if you see now, of course, we have very well anchored inflation expectations. So the key question is not just what's happening to wages, but what's happening to inflation expectations and how does this interaction work. And of course, there the central banks play a crucial role. I mean, I'm talking here in my personal capacity, of course, so I will not comment on monetary policy, and we had this sufficiently covered in the previous talks. But I think inflation expectations is something which is very important to monitor, to understand how this currently inflation shock will continue to translate into wages and inflation. Thank you very much.
Leland?
So it is an absolutely fascinating time to be a China watcher right now. I first went to China almost 30 years ago, and there have been periods of tremendous change, as we all know. But those periods of tremendous change are usually very obvious. You go to Shanghai one year, you come back 3 years later, and everything has just exploded up. Very obvious, everyone can see it. Being a China watcher now is trickier because there are enormous things happening. Some of them as big a deal as what we've seen in the past, but they're a lot harder to notice. They're a lot harder to see. The changes are a lot more subtle. When we discussed where I should focus my remarks here, there has to be sort of an episodic focus when you're only talking for 10 minutes or so. The last year has provided no shortages of them. So had I done this talk back in last fall, I probably would have been focused on the property crisis in China. Had we moved and done this late, maybe in the early winter and the end of the year, I would have been talking about stimulus. Why has there not been more stimulus in China's economy? Are we going to see it in a party Congress, politically sensitive year coming up? Had we moved into early 2022, I would have been talking, of course, about the Russian invasion of Ukraine and the effect on the Chinese economy. And then, of course, we're moving into times in which COVID and COVID lockdowns have become the name of the game. So what I want to sort of do is take a step back, look at the big changes, and then sort of hone in on where we are with COVID right now. The biggest issue right now, this fundamental change that I want to focus on, is that China's economic growth model is changing. It's changing dramatically, and economic policy making in China itself is changing dramatically. And you can see this quite clearly in the data if you look back 2 years. So when China shut down in early 2020 and began to emerge from a partial lockdown state, the recovery was impressive. I think the world was amazed at the speed it was able to recover. But it was an industry-led recovery. It was a supply-side-led recovery. You saw manufacturing pop up. Property came back, commodities came back, but you had a very weak retail and services sector, which shouldn't be surprising because that's what happened all over the world when COVID hit. But what have we been taught as China watchers to believe in? We've got a handful of things. The first is that the Chinese government, the Chinese Communist Party, believes in high levels of growth. They want to always hit and prioritize high levels of growth. They don't like to report weakness. If they have to report weakness, then they're going to stimulate out of that weakness so that they can report a message of stability. And when we enter party Congress years, like 2022, where once every 5 years, twice a decade, there's an enormous political changeover. This will be Xi Jinping getting a third term or more, but every 5 years you see big things happening in the Chinese economy. You see, monetary spigots open, you see fiscal spending, you see a big infrastructure push. All of these things were expected. There is a playbook that Beijing has provided us for several decades, and that everyone has been taught to follow. But the last 2 years have not worked out the way the playbook says. So if we look back at this COVID recovery, you had the industrial recovery at the beginning, but you had this weak retail and services. Now, what that led everyone to predict is that there would soon be a huge consumer spending surge as the economy normalized, because China looked like it was getting back, and it would soon be back to normal, and the government, of course, would prioritize returning to those high levels of growth because that's what Beijing likes to do. Everyone was pretty surprised when mid-year that didn't happen. Now, when we were looking at China Beige Book data, we were quite taken with this, because during a time in which everyone was predicting there to be this big consumer spending surge, we saw some of the weakest retail sector data we've ever seen. The headline data was weak, but investment was worse, hiring was worse, borrowing was at the lowest level we'd seen in 10 years. So something was different. The playbook seemed to be changing. But then, of course, the assumption was, all right, well, you have weak retail data. There's no other recourse but for the party to stimulate. So there was all these predictions of, interest rate cuts and RR cuts and other things. Because remember, this was happening at the same time as Xi Jinping was starting his tech sector crackdown, and you had weak data. Basically, everyone came out and said, look, there's only one way that Beijing usually handles this. They're going to stimulate heavy into this because they have got to get things back to a message of political and economic stability. That never happened. And if you look what happened in our data, from China Beige Book data from 2021, all the way through the year, all the way into 2022, we saw the tightest credit conditions we'd ever seen. Property crisis in the middle of the year, it didn't matter. The tightest credit conditions we'd ever seen. Retail sector data hurting, consumer spending falling off, it didn't matter. These were still the tightest credit conditions we'd ever seen. All the way through 2021, into the end of 2021, and into 2022, so much so that first quarter and even our April data that came out a few days ago show the tightest credit conditions we'd ever seen in 10 years, and it's all happening in a row. So there is not this stimulus playbook that's kicking in right now. What are the Chinese doing? Well, right now there is a refocus from what the traditional focus of the party has been, which is high levels of growth. They're worrying about restructuring the economy. They're deflating the property sector, they're de-risking the financial sector, and they're trying to usher forward new levels of slower, healthier growth going forward. Now, the question is, in a party Congress year, will this ever change? And we're seeing now, have been seeing for a couple months, something very interesting in the credit data, which makes it different than 2 months ago or 4 months ago or 8 months ago. So we are seeing these enormously tight credit conditions. But at the same time, while loan applications have been falling off, so firms have been getting more and more depressed about borrowing, we're actually seeing our pent-up credit demand meter go up each of 4 or 5 straight months. So this is a weird juxtaposition. Firms are applying for loans less and less. Credit conditions are tight, but firms are registering to us both explicitly and indirectly that they want to borrow more and more. So why was this? Because the cost of capital in China is too high right now. A lot of people have gotten the signal from what's happened with a loan prime rate, a benchmark interest rate here, an open market operation here. When the rates are moved down 5 basis points, 10 basis points, there's this idea that China is easing in some meaningful way. China has not been easing. What's been happening is the corporates are reporting some of the highest borrowing rates, interest rates, that we've seen in years and years and years. So the implication in the short term from this was quite interesting, that with corporate loan demand returning, we could finally be in the midst of this pivot, this policy pivot, where the government steps in and says, enough is enough. We're going to try to improve the fortunes of the economy, try to boost sentiment, try to boost economic growth in this party Congress year. The time looked right. But guess what happened? COVID. So on the one hand, you had the situation where corporate loan demand was returning for the first time in 12 to 18 months. Politically sensitive year. You want to try to get sentiment back up. So it looked like it was going to be the right pivot point, but you had COVID hit. And to be more specific, you didn't have COVID hit, you had COVID lockdowns hit. Because the average, if you add up all the COVID cases in Beijing, you may not get more COVID cases than in the average, US or European movie theater during the height of the pandemic. So it's not an issue of COVID outbreaks, it's an issue of the COVID zero policy. And what Beijing has essentially done is shut down parts of the economy starting in March, throughout April, and you're continuing now into May. And you're saying a very interesting question then pop up. Is this the time in which the Chinese government would actually like to ease policy, provide more policy support, bolster some of these faltering expectations? But even if it is, can you stimulate an economy that's essentially shut down or partially shut down right now? When you're talking about 40% of GDP under lockdown, the numbers change. So it's a very interesting situation. May 2022 is probably the most important month in China since January 2020. Because when we see the extent of the COVID lockdowns, we will understand the limitations to what China has in terms of growth. They're going to, if we see lockdowns throughout May, you're going to see China in contraction in the second quarter. You're going to see also secondary effects, which my colleagues here will be talking about. The ports are backed up. The arteries are clogged in China. The cities aren't just shut down, but you've got the traffic arteries clogged between them, and 4 of the largest ports in the world shut down. It hasn't gotten to a point where these have affected most of the rest of the world, but we're about 1 or maybe 2 weeks away from that happening. So if we see lockdowns continuing throughout China, including the major cities like Beijing and down south, throughout May, we are probably going to see a completely different world in 2022 than we otherwise would have. And this is going to be big question marks for banks like, central banks like the Banque de France and the Fed. Thank you.
Okay. Thank you for that enlightening commentary on what we can expect with coming supply chains. So I'm going to cover the U.S. and cover 4 main buckets: Russia, Ukraine, inflation, growth, and monetary policy in 10 minutes. The Russian invasion of Ukraine. The U.S., unlike Europe, has insignificant financial linkages directly to Russia and Ukraine. The main channel of transmission, though, is to financial conditions in the U.S., financial conditions spillovers, which we have seen, and trade. And so it's not without its economic impacts. When you're modeling out these things, the impact on GDP in the U.S. Is a few tenths of a percentage point. The impact on inflation is 4 times the impact on growth in the U.S. So this adds to the COVID and inflationary impacts that we've seen, spillovers from China, where I agree with the governor, this is not stagflation. Economists are very literal. Stagflation is negative growth with high inflation. But it is a stagflationary-like shock. Estimates for inflation continue to move higher. Estimates for growth continue to move lower. And financial markets will trade it like it's stagflation, even though it's not technically stagflation. The higher energy prices are biting in the U.S. In particular, we've been very focused on the low-income households. I'll talk more about those, the consumer experience in a moment. And it's putting further upward pressure on inflation, which complicates monetary policy for the Fed. So that's where we are on Russia, Ukraine. I think the Treasury already has secondary sanctions built into their generalized language in sanctions. So that's an automatic trigger. And I think sanctions will continue to ramp up. On inflation, I mentioned energy. Besides energy prices disproportionately impacting the lower income households, we also have food prices and rents. So rental prices in the U.S. Are growing at extreme rates. And a lot of rental contracts are resetting now and resetting at a double-digit year-over-year growth rate. This is an underlying element of inflation, which is more indicative of a tight domestic economy. So monetary policymakers are quite focused on it. We are quite focused on it. It gives you a clear picture that things like tight labor markets create those inflationary spillovers. It is actually one of the few components of CPI that has a perfect Phillips curve relationship as the unemployment rate falls, and we have a very tight labor market in the U.S. Back in November, inflation became the #1 concern of households in the U.S., surveys showed. #1 concern even above COVID. Interesting, though, when we talk about inflation expectations, Both the governor and Isabel also talked about how important it is that those remain anchored. You can see that short-term inflation expectations among households have skyrocketed alongside prices, but medium to longer-term inflation expectations have remained relatively stable, so still not an expectation that these high rates of inflation will remain. And that's important because we do have extreme wage pressures in the US. Now, my outlook is that those wage pressures will be coming off. We've already started to see it in some sectors. The restaurant sector, for instance, applications have surged there. We started to see wage pressures come off in that sector as we get more people back to work. The labor force participation rate for prime age workers in the US, so age 25 to 54, has picked up much more rapidly than in prior recoveries. And part of that is we're getting COVID further into the rearview mirror, where people are less concerned from a health perspective. It sounds funny to say, but health concerns around COVID are still the #1 reason keeping high-touch service sector workers out of the workplace. So as they're coming back, we're seeing those wage pressures come down. Still, wage pressures will remain historically high, just not as high as they are right now. That's important because we expect overall inflation to be coming off these peaks, and it'll be most notable in the second half of the year. And I'll join all my colleagues in how wrong we've been about inflation, so let's see if we get it right eventually. But that's important because nominal wage growth is quite strong in the US, but it's not outpacing inflation, so real wages are declining. And so that's the skinny on inflation. On growth, GDP will be sharply slower this year. And I'm not just talking about because GDP in the first quarter was minus 1.4%. If you took out the volatility around trade and inventories, private final domestic demand was more than 3.5%. So it was quite a strong growth rate in the first quarter. But still, growth this year we expect to come in around 2% GDP. That's sharply slower than last year. It's primarily driven by a slowdown in the consumer sector where we had 7% growth in consumption last year, and we're looking for it to come in around 2% as well. The investment picture in the US is quite robust. So we're having the strongest CapEx cycle that we've had since the 1940s, a lot of that driven by technological adoption. We also can't forget that wage growth, the reason why economists like wage growth, even as businesses don't, is because it precedes capital deepening. And so we have seen a more broad-based capital deepening on the back of those higher labor costs. We also can't forget that we already passed legislation last year that enacted significant infrastructure spending. The bulk of that hits in the fourth quarter of this year. And so that's also a support to investment this year. Housing is slowing, as it should. Demand for durable goods is slowing, as it should. This slowdown is intentional. Interest rates are rising, and those are the sectors that are impacted the most. So this slowdown in the economy is welcome, and I think it's important for us to remember that. We need the economy to slow for the Fed to create slack in order to bring inflation down. It takes 4 to 6 quarters to impact inflation through monetary policy. And so that cumulative effect of interest rate increases is important. So let me finally go to monetary policy here. So typically the Fed prioritizes growth over inflation, right? Because if there is a slowdown in growth, eventually there would be a slowdown in inflation. But it's not just the Fed, it's other central banks as well that have had to prioritize inflation over growth this time. So Russia-Ukraine being the last development creating a further surge in inflation, the central bank is responding to that because it comes on the back of higher wage growth and higher sustained inflation, which has broadened out in the US. So they are prioritizing inflation. The committee has a strong desire to move, to use Chair Powell's term, expediently toward neutral. So we're expecting a string of 50 basis point hikes here before the Fed moves into 25 basis point hikes thereafter. Once you get to neutral more quickly than you have in the past. The Fed has a more cautious view, or at least we've heard from Chair Powell on Wednesday, a bit more cautious view on sort of getting the state of play, seeing how the cumulative effects of those policy increases come through. What is your financial conditions backdrop, economic backdrop, and then you can proceed to move into restrictive territory. How far they need to go into restrictive territory, they don't yet know. Our estimate is that the peak rate in this cycle will be 3.125% if we're thinking about the midpoint of the target range, and that we'll hit it in the first half of next year, that we will be at the Fed's estimate of neutral at the end of this year. And so it's a more aggressive Fed, or more expedient Fed, but not a Fed that doesn't come without still some caution, especially as we approach neutral. The balance sheet runoff is beginning June 1st. It is actually not as gradual a ramp up as we thought. It's really a very quick jump to the maximum caps of $95 billion a month. And so I think some of the caution of monetary policymakers of how far they need to take rates in this cycle is a recognition that they don't yet know how the balance sheet will affect financial conditions. When the Fed is in quantitative easing mode, they directly impact financial conditions. They're buying in the secondary market. They know how that will affect interest rates. When the Fed is doing QT, so allowing assets to roll off the balance sheet, they have no direct control over financial conditions. The Treasury does. So it depends on how Treasury decides to replace that debt. And so you want it to run in the background, and I won't use the term watching paint dry, but you want it to run in the background, but recognize that you are pulling two levers at once, and it's difficult to pinpoint the impact on financial conditions when you're doing that. So in the interest of time, let me stop there and pass it over.
My turn. Thanks to you, Michael, and to GIC and Banque de France for the invitation. And I will try to as you invited me, to complement what colleagues just said from maybe a slightly different standpoint, which is the one of a public development bank. An international one, AFD I'm heading, active in 115 countries in the world, including China, actually. And so maybe able to feel and convey what the rest of the world is thinking of the situation. And also I've been a diplomat for a long time, both at the Treasury in France and at Quai d'Orsay, now turned as a financier. My view, my thought is that we are facing a very unique and complex combination of crises and challenges, and probably it requires renewed diplomatic and financial capacities, skills, and that should factor in and mobilize the Global South somehow, maybe more than what we will deploy following what we feel from the crisis. The war in Ukraine is, of course, dramatic. It has huge consequences, but somehow this is a classic crisis. I mean, an old one revived, and of course, all the diplomats are very active in order to rebalance the disbalance of power that has been created by the war. And we have to define monetary policies, mobilize international financial firepower like we planned it, or we know it. And of course, that's extremely important, but somehow we have to be cautious, not following only old lines and old solutions as we prepared for so long. Because at the same time, and intertwined and maybe linked, you're dealing with interdependence. Well, we have the underlying climate change and SDG challenge, which we are all taking into account now. Of course, development finance institutions, they know it by heart. But now, because of the need to invest in climate solutions, and I mean, these long-term questions are, and I heard François said it, are a challenge to all segments, actors in the financial systems. For now, and for climate change and SDGs, and I include Leland, I include COVID in the second dimension of what we are facing. We need another diplomatic capacity, because it's not about rebalancing. It's really, we need to find, that's what the conference of the parties, what the UN is about. We need to find a way for all parties, all powers, to move forward, which is very different from the way we react to a geopolitical classic crisis. And we also need on the financial side probably another architecture, and something which is not an international issue, which is really a capacity to mobilize at the local level and finance the transformation. And of course, the question now is, are these different crises we are facing contradicting? Are we losing time? Or are they interrelated? And could we find a way to both face the short-term shocks and also be more active on the long-term perspective? And my second point is, of course, to plea before all of you to factor in the Global South, not as an afterthought, but really as a part of the solution, which is of course not what we've done in the past at all. So we have to do it for reasons of, I would say, justice and for our own interest, because of course the Global South is disproportionately affected by these twin crises. So I'm not going into the details of what the soaring prices of food and energy is doing for so many African countries and beyond. But I just remind you what happened in 2007 and 2008, the last time the prices were that high, and the political disturbances we had to deal with then, including the Arab Spring, so-called Arab Spring, that is still so strongly reverberating in all our societies and economies right now, and we know it by heart here in France and Europe, and also on the climate adaptation side. Because of course Africa is not responsible for, it's a bit different from China, because we see emissions in large, big emerging markets rapidly catching up with what we did in the past, historical emissions. So the question of climate justice will, in the coming years, will be seen in a very different perspective, geopolitically. So there's a risk attached to this situation, but there are also opportunities. I mean, and probably, well, you know better than I, but what I hear from very large firms, global firms, is that if we seriously want to decarbonize our value chains, I mean, of course, we have to invest in innovation. And we probably, with the existing technologies, are able to follow the right trajectories for the next 10 years. But we don't know how to do it by 2050 and to reach net zero. So we will need more innovation for sure, but we will also need compensation, and we will need to invest in carbon sinks. We will need to invest in forests. We will need to invest in and where are these opportunities? I mean, there are also, of course, mostly in the global south. So the question is when all of us we will pivot really and turn to climate. Where are we going to invest? I mean, and are we ready? Is the machine to originate way more bankable deals that are positive for climate and sustainable development? Is it ready? Or will it only fuel more inflation in our economies? My guess is that we're not we're not ready at all, and we have to invent something way broader and way more concrete than what we are doing. And I close by saying that probably the way multilateralism is defined, operating right now is not sufficient. I prefer polylateralism than multilateralism because it's not a space in itself. It has to have traction on the territories, on the countries, on the actors, and probably sorry to say, but what was said 30 years ago and synthesized in what we call the Washington Consensus is probably a bit too short as well. And I say it from my perspective, which is what we feel as public development banks. So I don't know if you are aware of it, but we try now for 3 years to regroup these institutions that were supposed to disappear. I mean, basically, because we think that there's the governments with their budget on one side and then the markets, and there's nothing in between, which is plain wrong. Because we did the research and we found about 530 public development banks in the world. The geopolitics of it is very interesting. You have it, they're all over the place, including in very poor countries. Well, you had it in the US for so long. It was called, if I'm right, the RFC, Reconstruction Finance Corporation, that disappeared in the 1950s, but that was so active to face another crisis of the magnitude we're in, which was the one of the 1930s. So my point is, when you add the financial capacity of all these institutions, it amounts to 2.5 trillion investments a year, meaning about 15% of total investments. So we see public banks are very small things that are not macro critical. My invitation is for you all to consider the group as something that is macro critical, and that, of course, is following the guidance of governments. So I ask our public shareholders first to ask us to do the counter-cyclical and to do the structural role that we are doing, and to do it together with the multilateral development banks as far as the local development banks, as a vast architecture, and not for ourselves, but of course to complement, to add, and to do what the markets are not able to do in such a crisis. So maybe I stop here, but just to tell you that we've created a movement that is called Finance in Common. Third summit will take place this year. At the disposal of all colleagues to be challenged, because I'm not saying public banks are perfect. They're not, by far. Sometimes there's a lot of overlap with what commercial banks are doing. But because of the magnitude of what we are facing, we see the central banks with the NGFS, it will be discussed this afternoon, the private sector with this Global Financial Alliance for Net Zero that Mark Carney framed in Glasgow last week, and the public investment side, I would say, through this finance in common gathering of all public development banks in the world, ready to have a more probably strategic and operational discussion, maybe to support the G20 Indonesian presidency, next India, next Brazil. So the Global South will be very, very active in the coming years in the global governance, including on the financial and economic side. Try to find ways, innovative ways to do the right investments and do the counter-cyclical role that is expected.
Thank you. So we have a few minutes for questions. I'm just going to ask one of the panel. Given this meeting with the Banque de France is put on by the Global Interdependence Center, one of the problems I see in the world today is that we didn't get the world we expected in 2022. I mean, one of our panels is on climate change. We expected to be facing that problem, but we didn't expect to be facing a lot of the other problems. In the United States, I don't think the Democrats thought they would be where they are right now politically. In Europe, they certainly didn't expect that they would be where they were with the Russians. And in China, I don't think they thought they'd be where they are with COVID. Given that these are kind of local problems for each one of the three large regions, how, with the deglobalization that's hanging over us all, where are we on global interdependence from the perspective of your three regions?
Should I start? Maybe I start and then I let my colleagues complement. I mean, I think globalization is kind of the flip side of peace, right? Or vice versa. So I think what we're seeing now is, kind of a move away from these global interdependencies, but what we have at least seen in the near term is that we're extremely globally interdependent for the moment, right? So we can, of course, ask the long-run questions, are these geopolitical developments and what we're seeing going to do for global fragmentation, but at least what we have seen so far is that we are extremely interdependent, right? So what's happening in China is having immediately a knock-on effect on Europe, and you may say what's happening in Europe in terms of the war in some countries is very remote, but what's happening then through the commodity price channel is having its spillovers across the globe. And I mean, if you look also at the financial sanctions, when we're talking about imposing sanctions on Russia, especially the financial sanctions, they're very effective in the immediate effect, but then they become less effective because there's ways around. And why is that? Because we're so interlinked, right? The financial system is in ways interlinked that we're only discovering as time goes by. And I think there are some factors that will continue to maintain these linkages, like digital currencies will mean that this interdependence will continue to be there. But I think the fundamental question to ask is not the point in time, but where we're heading for this, right? And I think, as mentioned, globalization and peace are flip sides of each other, and we also know that there's a peace dividend, right? So there's a bonus that we had from having peace, and I think that's the biggest risk that we see now, that we have taken that for granted, but that this will dissipate.
So if we're talking about deglobalization, I'm often focusing on a subset of that, which is decoupling, U.S.-China specifically, decoupling. And I think that is happening and will continue to happen, but it's important to understand that supply chains, for instance, are not monolithic. You don't just get rid of supply chains or keep them. You have certain types of decoupling that's happening. Tech sector decoupling is already happening. The U.S. and China are getting rid of each other's gear so that they're not compromising the respective systems, pushing separate 5G programs, obviously. You could see some other types of supply chains move more and more out of China, whether it's PPE, whether it's pharmaceuticals. These, depending on how serious the U.S. Congress gets on some of these. And I think from a business standpoint, you're looking at a future in which companies are increasingly going to be looking at their China businesses, and then are going to be looking at their ex-China businesses as discrete from each other. So you're going to have Chinese businesses, global companies, invest in China. They're going to be, they're having production in China, but that production in China is going to be for the Chinese consumer, maybe for a few neighbors. And then the production outside of China is going to be for the rest of the world. So you have elements of decoupling. The problem with the topic is it usually gets seen as a binary thing. You're either going to have a decoupled world or a not decoupled world. And the reality, particularly in the US-China universe, is something hazily in the middle right now.
Thank you. So I think you mentioned the Democrats. They are in a very tough spot for the midterm elections this year. It'll be difficult for any of the incumbents, and particularly among Democrats, to maintain their seats in in this inflationary environment. Inflation is a campaign killer, and it's why President Biden and the Democrats have been so focused on fighting inflation. With the Fed even locking arms, where the doves and the hawks are both very focused on fighting inflation. I think there's been a lot of discussion in the US about removing tariffs on China. It is not what the Treasury is focused on at all. I mean, tariffs are here to stay. If you remove the tariffs that came about from US-China trade tensions, it is not a game changer for inflation. So those tariffs will remain. It continues to be a bipartisan, it works for both parties to keep pressure on China. So that's not going away. I agree that it takes a very, very long time, and it's very costly to disentangle global supply chains. And so I don't think that's something that changes overnight. We may even look back a decade from now, as we did a decade beyond Japan's earthquake and tsunami, and see that nothing really has changed. I think at the margin, though, you will get some, and so I think we've been calling it slowbalization instead of globalization. And it's one reason why the disinflationary effects of globalization over time, we can't assume will continue to exert the same downward pressure on inflation going forward. And in the end, we may end up in a heightened geopolitical environment that creates a multipolar world. I think these things are very slow-moving beasts, and it's very difficult to see them clearly in real time.
No, maybe just invite all of you. I recently read a very interesting book by Mark Leonard, the head of a think tank called ECFR, that is studying the way each interdependence is now weaponized somehow, or can be turned as a weapon. So maybe, alas, I would say, the conception we had for so long, for decades, that independences were good by themselves, and that somehow there will be self-governed mechanisms. That dream has come to an end, and be it financial flows or migrations, or, I mean, they're not good by themselves, and so there's probably polars that will emerge somehow. Value chains will be revised, but if we want this movement to happen while keeping sufficient growth, while keeping social cohesion, while avoiding political disruptions, we certainly have to pay a lot of attention to the global governance, which is in default right now, dramatically. And that has to be somehow reinvented, and we hope our leaders will find a way, despite the tensions that are so high, to find a way to govern it all and manage a transition, a long-term transition that is positive for all of us.
We'll open it up to the audience. Yes, sir, right here.
Thank you very much. Can you hear me? Thank you very much. It was a very interesting panel. So given that the session is on economics and geopolitics, I have a question on global currencies. So at the moment, the dollar is really the dominant currency, but we've seen some evolutions and some requests by Russia, for example, to be paid in rubles. So the question is, do you think that this can significantly affect the role of the dollar in the global economy? So I guess all the panelists can answer the question, but maybe Isabel, being a specialist, I'd be interested to hear what you think about this. Thank you.
Yeah, so I think, I mean, the discussion on whether the dollar will remain its dominant role in the world, I mean, that has been going on for decades, no? And I mean, there's always people looking for signs that we're moving to this multipolar world. And I think at some point there was a discussion on the Chinese RMB also becoming more prominent in the global stage. And, you know, it has always turned out to be more of an issue for debate and something that we saw in the real data. And of course, the war has reinvigorated that discussion. And I think it's not only the discussion on the payment in rubles, but for instance, also the swifting of the banks. To what extent will you know, other countries or institutions in other countries move away from SWIFT to other payment systems? And are we going to get some sort of a multipolar world? I mean, my personal take on that is that I don't think it's very likely. I mean, I think the key things that you need to have global currency is just very deep liquid financial markets, sound financial institutions, good governance. And so any currency that wants to compete with the dollar will need to make sure that it has that. And so far, you know, China has tried to like foster its international role, but it doesn't have these deep and liquid financial markets, and it's still very far from that. And of course, maybe I'm going to turn out to be totally wrong, and then 10 years you'll tell me you missed something giant here. But I think so far I don't see any currency that is at this point able to challenge this dominant role of the dollar, basically. Thanks.
Just a quick note about the yuan. So much talk about the global role of the RMB, its rise, et cetera. It's about 2.6% of global payments. And I think what's most important here is that we recognize the difference between the yuan rising as a global reserve currency, which is not going to happen anytime soon, decades from now, may never happen, and yuan internationalization, which is something that the Chinese leadership is pushing to try to get certain small amounts, whether it's in oil or whether it's in certain bilateral trade, done a little bit more in yuan. But the central reason that we could talk about why the euro won't replace the dollar, the yen won't replace the dollar, the IMF currency won't replace the dollar. What gets brought up more and more is the yuan will rise, and there are a lot of reasons, most of which Isabel mentioned, why the yuan will never rise or will not rise anytime soon to be a global reserve currency. But fundamentally, the number one reason is because Beijing does not want it to. In China, the financial system, the economy it piggybacks on the stability of the dollar. It piggybacks on the stability of the yuan peg and the U.S. dollar financial system. So right now, not only is it a long haul for the yuan to rise, even in optimal circumstances, it is not in the interest of the leadership in China to sacrifice this stability for some theoretical rise in the global use of the currency, which would actually probably put their reserves and other plans far more at risk than staying as is.
Thank you all for your discussion. I've heard you discuss the uncertainty factor is growing dramatically with the various crises. I've heard no mention of worry about the smartest guys in the trading room. As I look at the government bond markets, there are still large negative real rates on those. The fluctuations of the equity markets have been dramatic since 2020, and certainly since March of 2009. What are your how do you identify the principal vulnerabilities of the financial markets at this point, especially considering not only the smartest guys in the trading room who are always looking for ways around the regulations, but also the fact that the non-bank credit sector is generating more credit than the banking sector?
So I think and this may not answer your question exactly, but I think the way monetary policymakers look at it is something that Jeremy Stein, former board governor, had espoused, and that is that as you are raising interest rates to slow an overheated economy with overheating markets, that those higher interest rates will get into the cracks. You know, they've often talked about leaning on macroprudential policy over raising rates in order to address bubbles. But I do think that trying to rely just on macroprudential policy is dangerous because it doesn't move quickly enough. Financial conditions or bubbles can work almost like a frog in boiling water that doesn't really realize it until it's too late that it's gotten burned. You know, I think following financial conditions very closely is one way for them to monitor. I think there's a prioritization in those. So for instance, it's not the job of the Fed to prop up equity markets. Chair Powell tends to take a Calvinist approach when thinking about equity markets. The wealth effect in the US is extremely small. And so if it's just equity markets having big sell-offs, the Fed is less concerned. Rapid movements in financial conditions, though, do present risks because it makes for a more uncertain outlook. But if I were to think about the channel of financial conditions that matter most, it's credit. And now credit spreads have widened, as they should when markets are properly taking into account the path that the Fed has communicated. Funding levels are still okay, but that will be the primary, the Fed will watch that primarily as one of their directives is also to ensure healthy credit flows to the economy. And the hope is then that raising interest rates in general will start to meet out any bubbles elsewhere.
Yes, sir.
Thank you. I have a question on the evolution of currencies and the key currencies in the last months, and the fact, for instance, that the euro has depreciated vis-à-vis the dollar by 10 or 15%. And do you think that the benign neglect is viable, sustainable in the medium run? This is my first question. The second question, perhaps more specifically to Rémy Rioux, does he think that the hike in interest rates is going to raise difficult issues and perhaps further weakness for the financing of emerging economies?
Do I have any takers?
So maybe on the euro, is the 15% depreciation sustainable?
I mean, it's always a bit difficult for a central banker to start talking about exchange rates. So normally we don't comment on them. So I was gonna skip on that question. I mean, maybe I was just gonna jump over on the difficulties for the emerging markets. I mean, actually, what we have seen so far, compared to previous episodes of monetary policy normalization, is actually, you know, we've seen some capital outflows from emerging markets, but markets have been relatively calm compared to what we saw in the past. And the key question is, I mean, on the one hand, we see some of the fundamentals have improved, but there's still this key question, I mean, have they really improved sufficiently that we will not see this turbulence in financial markets? And I think that's an important question going forward. I mean, you know, they did ramp up a lot of debt. And I think that also ties to the previous question, what is a vulnerability? I think sovereign debt is a vulnerability, but it's not just in emerging markets. It's actually almost a global problem in the post-pandemic environment. But unfortunately, I'll skip over on the exchange rate question.
Rémy?
I was in Niger a few days ago and I got a cold, so it's not COVID for colleagues. Yes, the raise of interest rates is of course an issue. So my plea to central bankers and others to factor in the global source was, of course, we know what happened in previous phases for these economies and what happened. And the fact that maybe governments at the international level and also in various countries should ease this trajectory by mobilizing public financial capacities is also a way to face this situation. Of course, we're in a very different world now, probably for a long time, which is something we knew in the past, and public banks were somehow born for that. But we have to come back to what we did in the past in that perspective.
I will say that on the currency front, one of the things I've been talking to people about in the United States is the money veil is that when you have inflation almost as high as 10%, you have to reset your brain to think about every price because it's not the price that you really think it is. It's something, lower in real terms. And now we have a 10% shock in the dollar against most currencies, 5% against the yuan. And again, you have to think in terms of everything. You have to make an adjustment. So for instance, the US stock market is down 10%, but only in dollars. It's not down at all in other currencies. So I mean, to think through how these things really work out in real dollars now, I think only those of us who survived the 70s have had to do this recently, or those who have been in Argentina. But, so it's interesting to see how the currency is creating a new money veil. I'm looking for my boss. Is that Jill up in the top corner? No? It's 11:43. We have time for one more question if someone is interested. Kathleen?
Thank you. So this is a question for Rémy. I'm deeply worried about what you were talking about earlier, that interdependence can be weaponized and the global governance is in default right now. If you believe in a fragmentation, a global fragmentation, let's say of trade blocks, let's say, how can we rebuild a global governance, and how can we rebuild faith in multilateral institutions? Thank you.
So it's not, of course, we are all believers in multilateralism and global action. I was only highlighting the risk that is attached to the multiple crises we are living in, and maybe the need to adapt our way of thinking, our way of negotiating to actors, of course, that are playing independencies in their interest, of course, but also against the other. While we had in mind probably that there would be an eternal progress towards global peace through trade and the development of the financial systems. This is not exactly what is happening. So what's the way forward? I mean, it's beyond probably our capacity. It's up to our leaders to define it. We put a lot of hope in the G20 and the last crisis we had to face. So let's see what again this sequence of very large emerging economies heading the G20 in the coming years will make out of it. Will it strengthen or will it weaken this forum? Well, we know what happened at the UN level because of the rules at the Security Council. It has to happen somewhere, and probably with regional pillars that are a bit more structured and active. I mean, see what happened for COVID. I mean, we started with a pure global multilateral answer, and we discovered that we needed regional pillars very active, not opposing the multilateral mechanism, but being able to deliver what is best delivered at a regional level. And probably we're not necessarily immediately thinking of an architecture that is a bit more complex, probably, but that would be probably more efficient for these large global common goods.
Well, I'd like to thank you all. Please join me in thanking our guests.